Hello traders. Imagine a simple yet reliable strategy that requires only two indicators. The first one is the simple moving average with a period of 100. It helps us determine the trend. When the price is above this average, the trend is upward. If the price is below it, the trend is downward. The 100 period setting gives us a smoother picture, neutralizes noise, and shows the market direction on a midterm time frame. The second tool is the Chaikin Money Flow, an indicator of money pressure. It shows whether more money is flowing into the market or out of it. If CMF is above zero, it signals inflow. If it's below zero, it signals outflow. A combination of the CMF signal and the price's position relative to the 100 period moving average gives us a simple logical formula. The rule is simple. If CMF crosses zero from bottom to top, and the price is above the moving average, this creates conditions for buying. If CMF crosses zero from top to bottom, and the price is below the moving average, this creates conditions for selling. But confirmation is crucial. Candlestick structure, support or resistance levels, and common sense. Indicators don't replace analysis, they filter noise. To avoid losing your deposit, it's important to determine in advance what percentage of your account you're willing to risk in a single trade. The optimal level is up to 2%. For example, with a deposit of $1,000, that's $20. If you trade confidently but are limited by your own capital, Hash Hedge will help you scale. The platform provides traders with borrowed funding of up to $100,000, and you don't risk your own money. And 2% of $100,000 is already $2,000 of potential risk, and accordingly, up to $4,000 in profit with a 1-to-2 risk-reward ratio. In practice, choose the nearest available lot size and adjust your stop or risk level slightly if needed. When exactly should you enter a trade, and where do you place your stop and take profit? The buy signal looks like this. CMF rises above zero. The price closes above the 100 period moving average. Ideally, you should see a bounce from a support level or a candlestick pattern. With confirmation, place the stop slightly below the local low or below the moving average, depending on the distance. Set the take profit at a level that gives twice as much profit as your risk. But sometimes CMF gives a false spike in the direction opposite to the trend. Entering against the trend is possible, but requires stricter risk control and a smaller position. I prefer to avoid counter-trend entries without additional confirmations. If the market is noisy, increase the stop loss and reduce the lot. If the market is calm and the trend is strong, you can give the setup a bit more room. Let's look at specific examples. Here's the first one. Look, here the chart is in a long-term downtrend. Before that, we had a resistance zone at the local highs. We'll use this zone when placing the take profit. So, according to the strategy, we have a signal. The chart crossed the moving average from top to bottom. It's below the moving average, and we're in a long-term downtrend. We also have confirmation from the CMF indicator. It's now below zero and confirms the downward move. For this trade, we can place the stop loss here at the 104,000 level for Bitcoin, 10 to 20 points above the local high in our resistance zone. And we set the take profit with a 1-to-2 ratio. So if we risk 10 points here, we set 20 points there. Choose a lot size so that the risk is about 2 to 5% of your capital. If we entered here at the point where we saw the crossover and the CMF confirmation, we would have cleanly executed this trade up to the take profit. The chart wouldn't have returned to the stop loss. It would have played out perfectly. Let's look at another example. Here we have an uptrend on Ethereum. You can also see that we had a support zone where the chart bounced off this line 4 times. Here, the dotted lines mark the current support zone. So, according to the strategy, we placed the take profit slightly below the local lows, around 3,350. Here we have approximately 15 to 20 points of difference between the price and the stop loss. As you can see, the chart is now above the 100 period moving average. This gives us a signal for an upward trade. And the CMF indicator also shows positive, bullish volume. So here we get confirmation from CMF. If we entered the trade here with a stop loss of 10 to 20 points, we would place the take profit at this level, and the trade would also have cleanly played out to the take profit, giving us profit. If you're unsure, reduce the trade size. A couple of simple risk management rules and accurate lot calculation turn these signals into a repeatable strategy. If you enjoyed this, leave a like and comment on what topic you'd like me to cover next. See you in the next video.